Let's welcome in our next guest, Ajay Bodke, CEO and Chief Portfolio Manager, PMS at Parbhudas Lilladher. Ajay, thank you so much for taking out time for us. What do you make of the last 7-8 days, and where do you think the markets would stop seeing this selling pressure? You think it's just technical in nature and it will readjust in Jan once funds come back and they start to allocate into India and other emerging markets?
Good morning, Pankaj, for having me on the show. I think, Pankaj, we're in the midst of a strong risk of trade, and we are seeing large FI outflows as a result of that. There are a lot of near-term headwinds that the market will have to navigate. I think 3 or 4 key headwinds that we'll have to grapple with. Essentially, we are seeing sort of almost certain on the US front that there will be at least 3 rate increases to stay off medium-term inflationary pressures out there, which is in turn fueling this risk of trade. Also, the reflationary policies which will be pursued by the new president-elect, I think also are expected to lead to outflows to US. On the domestic front, I think before that, I think on the global crude oil front also, we are seeing that after 8 years, OPEC and non-OPEC members have had some sort of an agreement, and one clearly is seeing a good amount of oversight being exercised by some of the members out there. So the worry for a large oil importer like India is that if the oil were to touch $60 or $65 sort of in the medium term, then we are looking at a large pressure on on India's balance sheet. I think every $1 rise in crude prices leads to nearly $1 billion of outflows, increased sort of import bill, and also the government's fisc also gets under slight pressure because of the subsidies on kerosene and LPG. So unless the government is able to push either reduce excise duty that further increases the pressure on the fisc, or have to go in for increase in petrol and diesel prices. The government has gone in for 2 rupees increase, but I don't know sort of if the price rises, if the crude prices go up very sharply, that the government will go in for a complete pass-through, or will employ a combination of reduction in excise duties and increase. So I think that again is something that we must keep on horizon. Well, this demonetization thing has clearly pushed off the aggregate demand, consumption-led aggregate demand, both in the rural side in particular and also in urban side, by at least by 3 to 6 months. And markets are slave of earnings. Right now, we haven't yet seen any large cut in the EPS numbers for FY17. My guess is that I think as against 23% growth in FY17 earnings penciled in by analysts, one could see a savage cut out there. It could be nearly half of that so we could be ending up with around 10 to 12% earnings growth in FY17, and the bounce back in FY18 is completely dependent upon how fast the currency comes back in circulation. So I think there are these challenging headwinds, domestic and local, that we have to navigate. Plus, I think the rollout of GST from 1st of April looks quite unlikely and quite remote. I think maybe a July rollout is possible if the government and the central and state governments are able to reach some sort of agreement. So I think there are a lot of wall of worries that the market has to climb, and it's only then that the market one can see a trigger in the market. Also, some people are expecting RBI to cut rates aggressively after December 31st. But again, a falling rupee, and the fact that the demand is we don't know how fast demand will come back. So the external pressures also will keep RBI in check in terms of how much can they cut rates. So although the fall in the market, in my opinion, from here will not be excessive, maybe we could stabilize 100 points down from here in Nifty terms, 7800, 7850, that's the range. But what is it that will take the market up? I think that is something which seems very difficult right now to envisage. Valuations, yes, but the valuations are dependent on the earnings growth. And if the earnings growth itself is going to be cut savagely, then I think one will have to reconcile to the fact that the market will remain range bound for some time to come, Pankaj.
Right. In terms of NBFCs, what is your view? Whether it's a Bajaj Finance, whether it's a Bharat Financial, M&M Finance, any NBFC has corrected quite a lot. What would you look to, which names would you look to buy? And would you just wait and watch for the Q3 numbers before taking a big bet on any of these NBFC names?
I think, Pankaj, it would pay not to be too adventurous in case of NBFCs right away. You did mention that the prices have fallen, But then from where did they rise? If you just take a slightly longer term perspective, a year, year and a half, and look at what valuations they were trading, and then sort of this entire hoopla that got created for the right reasons. I think both in the asset and liability sides, they had great advantages vis-a-vis corporate focused banks, and that's why investors flocked into them. But that resulted in the valuations becoming too expensive. And now with demonetization, I think the credit demand has caved in. At the same time, there are a lot of worries about increasing delinquencies, because our interactions on the ground, especially in MFIs, clearly shows that there are worries emerging in certain states like Maharashtra or Uttar Pradesh, and there are some of these small-time political leaders, not maybe across the spectrum, who basically are fishing the troubled waters and trying to create a situation where the problem of delinquencies could aggravate. So I think wherever the disbursals have been in cash and the collections are in cash, I would advise investors to be very wary before they take the plunge, just because the prices have corrected by some measure. Let's wait it out. Let's look at the results. Let's look at the commentary from these managements. How have the the collections fared till 31st December, and what is the prognosis going forward? And only then I would advise investors to take plunge in some of the NBFC names.
In terms of the point that you made about Maharashtra, what can happen for something like a Bharat Financial or any other name, do you think that can have effects in other states as well, and that could be a big issue?
No, as I mentioned to you, I think our channel checks indicate that states like certain districts of Maharashtra, certain districts in Uttar Pradesh, I think are the ones where there is this incipient trouble which is being sought to be brewed. But I think the industry also is taking all measures, because finally this money that has been lent to these MFIs has come from the banking sector, from the Mudra Yojana. So it's a government's money. So I think they are trying to galvanize the administration into ensuring that a signal goes out to all the collectors and all the administrative staff that they need to be constructive in terms of their approach insofar as the recoveries are concerned.
Right. What would you look to buy then? Consumer durables, that's also have seen some correction. Would you be comfortable there? At least the write-off issue or any major debt issue is not a problem in those companies?
Pankaj, I think now let's step back and look how can a portfolio construct happen in the current circumstances. Now there are these three broad themes: investments, consumption, and net exports. I personally envisage very tough in terms of allocating large money in investment-led themes, because the private capex is completely moribund. Government is making an effort in reviving roads, railways, and some other sectors, but I think it's a long haul. I think on the net exports fronts, I think the IT sector currently remains in doldrums. There is a lot of apprehension about what policies in the first 100 days Trump will enunciate on H-1B visa front, whether he will curtail to a large extent the quota. And we have seen some of the stalwarts like Mr. Murthy advocating that in the medium term, the Indian outsourcing industry will have to think of ways and means of not relying so much on H-1B and nearshoring or recruiting overseas close to the markets they are serving. So I think that sector again is in a phase of transition. I don't envisage a strong growth both in top line as well as the margins. If you see, there's a good trend that's happening. Companies like Accenture, their margins are moving up, whereas companies in the Indian outsourcing pack, I think their margins are coming down. So there is a kind of convergence that is happening. So pressure on margins, tepid top line growth. I think make IT sector also a sector where large allocation can't be done. Although I do buy the argument that some of these companies are trading at very attractive valuations, but then those valuations are also a function of the expected earnings growth, which also remain very anemic, and I don't see a change happening in the near term out there. So that leaves, if we leave out investments-led theme and IT, then the consumption-led theme is the only theme that one can play on. And here I think the hope is that as the currency already comes back, 6 lakh has already been pumped back by the RBI out of 14 lakh that has gone in the system. So hopefully in a month or so, or maybe 2 months time, well, when a substantial amount of currency comes back in play, the latent demand in terms of consumption discretionary sector should bounce back. And that's why our hope is that allocation should still be done in good companies in auto ancillary space, companies like say Maruti Suzuki, Tata Motors. In case of banking, again retail focused banks. I think banks like IndusInd Bank and HDFC Bank would figure primarily in my portfolio. And if you want a slightly higher risk spectrum, then Yes Bank, which has managed asset quality quite well, could be looked at. In the cement sector, which has got mauled pretty badly, I think some of the mid-cap names have gotten very attractive now. Heidelberg Cement has come down from 150 levels to 106-7 levels. Very well managed company. EV per ton is very low, doing pretty well in its markets. So I think as and when some semblance of sanity returns, these are the names that people will turn towards. The other large allocation I would do will be in pharma sector, especially in the mid-cap pharma. I think which are bottom-up themes like Glenmark Pharmaceuticals, which has got approval for Zetia, and they're expecting a very strong $150 million of bottom line to come from that drug, which they'll use to repay debt, plus their emphasis on the new chemical entities going forward. So I think Glenmark can be a very good medium-term bet. Jubilant Life Sciences, in the correction that one has seen, one should continue to look at that company with a medium-term perspective. And Aurobindo Pharma also. So these trio of Glenmark, Jubilant and Aurobindo should form part of a core portfolio in my opinion.
Ajay, thank you so much for taking out time for us. Always a pleasure talking.